In this video, traders, let's look at different open types. Stick around. Hey guys, warm welcome to you. Thank you so much for joining me. All right, so the open can be quite a lucrative time to trade. It can also be an absolute death trap. So if you have a discipline challenge you're still working through, the open will just exaggerate that. It will find the cracks, the chinks in the armor, and it will massacre you. That sounds a bit brutal, and I didn't mean it like that, but it is very, very dangerous, the open, if you aren't sharp. And there's nothing wrong with not trading the open, right? There's plenty of traders out there who wait for the open to happen, the open in 15 minutes, 30 minutes, hour, and then go, right, let me see what's happened. Let me see the data. Let me recalibrate myself to that day. So you don't have to trade the open. It's not a necessity if you're a day trader, but some traders like to take advantage of the open. Some traders only have the opportunity to trade the open, and some people just want to get better at the open. So in this short video, guys, I'm not going to spend ages on this. I want to keep it brief and give you the kind of best stuff I can in a short amount of time possible, because I know you're busy, you know you've got other stuff to look at, other stuff to do, you're trading, etc. So let's get straight down to it. Different open types. I kind of look at things in 4 different ways, and this is actually the way that these titles are from the kind of market profile type definitions, and I don't agree with all of it, but it helps you imagine what we're talking about. So we've got the opening drive or open drive, and that is literally we start off and we just rip in one direction. You've seen all those before. Just sit there. Very often it's after a gap up or gap down. There's some sort of supply demand imbalance, and it's just a rip straight off. We'll go in a moment about how to take advantage of these. The open test drive, that is pretty much the same as the opening drive, but it's just that little tiny shudder in the other direction, very short, and then poof, straight away. We had one of these not too long ago after a data event. The market kind of went up, and it just looked horrible. The market looked weak. It looked like, hey, you want to get short straight away, but then it just started to creep up at the open. It was like, okay, just wait, and then you saw that first red coming, it just went boom, just literally straight down, like, right, that's it, I'm short on that, and just stop above the high. It's an easier trade to make. So I quite like these because you can structure a trade quite quickly from it, and it's easier to put a stop in. The trouble is with the open drive trade is if you're chasing it, very often it could be that, and you're like, oh, you know, do I get in quick? Do I wait for a flag? Do I kind of wait for it? We'll talk about that in a moment. I'm jumping ahead of myself, but this is the kind of difference between the two. All right, let's go down to the open rejection reverse. This is where you have a big drive in one direction, it just goes from that and just goes from straight in the other direction. And they're quite nice to trade as well, because if you can read them, obviously, but if you kind of don't get caught out and you're ready for it and you see the trend and you see the shift, then they can be quite lucrative, because very often that can lead to a really big move for several hours afterwards, because there's a bunch of people who are trapped. So you get that open, drives in one direction, rejects it, reverses straight back. Okay, and the final one is the opening auction. So this basically just sits there and kind of trades around the VWAP. I know that's pretty symmetrical on this chart, but you get the idea. I avoid these. Personally, I just avoid them. It's not my thing. I just lately I'm like, you know what? Just save, keep your powder dry for stuff that's much more potentially lucrative. It's got a chance for you to add to it. I just don't like these type of things. Now, can you trade them? Of course, of course you can. And really these kind of tend to oscillate around a VWAP. And if you're using some kind of Bollinger Band or some sort of VWAP band, or using some sort of support resistance levels, you can use a mean reversion type thing. But the danger you have, of course, is that at some point it probably resolves, and how long you overstay your welcome. There's nothing wrong with trading that, but for me at the moment, especially the current environment, I prefer to wait for something that's a little bit more clear. And if it looks like it's about to be that, I just won't trade that open. I'll be like, okay, come back in a couple of hours and see what the market's done, see how it's resolved. And if it's still in that situation, the screens go off and that's me done. But if it kind of resolves out and becomes a little bit more juicy and I can see a trade structure happening, and also it depends on the daily chart as well, zooming down into that, then I might get involved. But I'm not a big fan of that. So let's ignore that for now. Okay. Opening drive. So opening drive trades, your job really is to get momentum as quick as possible. And people are going to say, well, you buy the first, you buy the open, but we don't know it's going to be an opening drive until it happens, right? We can have clues, and I've talked about clues before, and you kind of looking at the prior market range, overnight range, the prior overnight, or the prior range as well. Did we close at the upper 10% or lower 10%? Was that wide range? Was the overnight wide range wide? There's also things you can do to gather clues, but ultimately we don't know. We can kind of think, okay, that might be the roadmap for the day. We don't know until the open starts, right? The open starts to run, then what do? Now what we don't want to do really, unless we're positioned on a broader time frame, is chase that open. You know, you might have people say, oh, you just got to buy straight away as soon as you see momentum. That's fine if it works, but what about if it's doing this? You know, what about if it's doing this and you're just structured wrong and you can get caught out? And this is why I said at the beginning, discipline's so important in the open, because it just can whip your face clean off. You're shorting that thinking it's going to fill the gap, and so you got a gap down here and you just happen to be positioned wrong and just goes bang, and you know, we're talking minutes before you know it's back through highs, and if you've got a deer in headlights syndrome, you know, you're dead. So open drive, I think the play with these is to, you know, let's assume you've identified a momentum, is to find a place to express that continuation of momentum with a structured stop. That's pretty much it in a nutshell. Now we can talk about flags, we can talk about first pullbacks, we can talk about range break fakes, all those type of things that are good, but ultimately all we're trying to do with those is find a way to join the momentum and structure a decent stop in a sensible position. Because if the market's just been going straight up and you buy, where do you put your stop? You can do a fixed stop by, of course you can, but it's not very structured. Whereas if the market's gone up and started to pull back, whether it's pausing at a flag, or it's dipped lower and pushed back up and it's a wick, or something like that, you can take the trade assuming the momentum is going to continue, assuming then that it's not going to go back below that little recent low, and you can structure a trade accordingly. So personally, I think that's a better way to do it. It's just to let it run, let it stall, and as soon as it stalls, try to structure a trade from the stall. Because actually as well, it could run and come right the way back in a long way before it then reaches again. And maybe then you want to trade the breakout and structure it slightly differently. But for me, it's always waiting for that hesitation or stall before I even consider getting in, unless, the caveat to that is unless it's a longer term swing trade and you're like, okay, I see it set up on a daily chart, I've got a wide stop, I'm just buying at the open anyway. You don't really care, well, you do care, but you don't really, you're not so sensitive to price as much because you've got a smaller position size because you're looking for a bigger move. But that's something slightly different, right? Okay, so opening drive, we're waiting for this kind of little dip and pull back. And at the end of the day, it's a good test of discipline, because if you see it going higher and higher and higher, you've got to keep sitting there and saying to yourself, listen, I want to buy this, but I will not chase this under any circumstances. It must do what I want it to do for me to get involved. And if it doesn't, that's absolutely fine. I'll wait for the next structure, the next rhythm, the next sequence of trades. It's going to be, in the day, what you've got to think about is this, is if you don't get involved in the open and it's a big open, there will be opportunity that day. Very, very rarely do we get a big open and just sits there all day long. Sometimes, but most of the time, if it's a big open and you're not involved in it, that's okay, that's cool. Because actually later on in the day, very often you get a rotation back to VWAP, you might get an afternoon breakout, you might even get a full scale reversal and trapping on those traders. So there's always opportunity. So this is where I go back to the beginning of the video. Like, hey, if you don't like to trade the open, or you feel like you get caught in it, don't bother. Just say, hey, if you've got a big open, that's great. It's going to open up different ideas and I can come up with different trade ideas for the day ahead. Whether it's pullback trades, reversal trades, whatever it may be. So opening test drive. This is, you know, something, again, if you've got a roadmap and you think, hey, we're going to continue this, that, the other, and you're basically seeing the price response. So if the price starts to kind of trickle lower, and you're like, okay, let me just see what happens. Is it going to gap fill? Is it this? Is it that? But it's the telltale sign for me is the speed of the move back in the direction of the trend. So let's say it's gapped up, okay? Now, by the way, if there's no gap here, I probably should have mentioned this. Sometimes you get an opening drive out of nowhere, but most of the time it happens after a gap situation or a catalyst. But imagine that is your gap there, it's gapped up. So there's, you've got a reason to expect that people might be getting involved. You know, if it starts to kind of trickle lower, you're like, okay, well, let me just wait. Let me just wait. And then you can time it and say, hey, when I get a first trigger candle, like a large, big green candle that takes out prior highs, that could be your entry. And again, going back to the, you know, we're talking about the opening drive, it's finding a way to structure the trade with a sensible stop. You know, many people go, oh, just buy the dip. Yeah, but that's in the real world, when it's tickling lower and lower and lower and lower, and you're long, you're like, where the hell do I come out? What do? Do I have a structure? Do I have a fixed stop, which is an arbitrary number? 50 ticks, 100 ticks? Do I leave it? Do I add? You know, you just get in danger zone. Whereas if you wait and go, hey, let it go as low as it wants. And ultimately, if it goes all the way down here, you may not want the long. But if it goes down, find some support, and then you start to see a little bit of momentum to the upside, you've still got plenty of time and plenty of juice left in the deal. And if you're buying it, let's say here, after, imagine you've got this momentum here, it's like boom, well, it's trickling lower, it's kind of up a little bit, trickling lower, and then you see, woof, you know, a big like solid green candle like that. We try and make it clear with these little open close pins. If you see that, that's better to wait for it than kind of be adding and adding and adding and adding, because if you add it too early, then, you know, ultimately you can end up getting kind of stopped out just when it's turning. Now, of course, it could go back lower and stop you out, but you've got more of a structured play, right? You can say, okay, good, there's my long, there's my stop, and I've got plenty of meat left in. Immediate kind of weight I'm looking for is back to the open, and if this is strong enough, you know, we could get a good trend day. And so you're already in relatively early anyway. It doesn't matter to try and fine tune it so much, but you're waiting to see who's the first who's going to commit. And then, most important thing, you have to structure the trade and putting that stop under that level. And by the way, you know, these are broad examples, guys. I mean, you know this if you watch the channel for a while. You know, I'm not here to tell you I've got all the answers, I absolutely don't. But I'm here to kind of show you things that I think are worth exploring. They're worth looking into a little bit more. These patterns are, you know, they repeat, sometimes, you know, repeat a lot of the time, sometimes there's different types of open, but it's stuff that's worth looking at. I think as a retail trader, you know, especially if you're looking at the open and you're trading the open and you're active at the open, it's worth categorizing them in your mind and trying to think of different plays and trade ideas and setups and playbooks for each different open type. But, you know, this isn't exhaustive, and this isn't going to find the detail, but it's just to kind of plant the seed a little bit. So that's the opening test drive. Okay, the open rejection reverse. That's, you might say, well, that's the open test drive marker. It's the same. Well, not quite. And yes, it's similar, but this is more like, okay, it looks like, whew, it's momentum. This is more drift. Okay, this is technical stuff, right? This is more what I call drift. So it's drifting lower. It's just like tickle, tickle, you know, just plodding down. You know the type, little red candles, pops up a bit and just goes. It's a grind. It's a drift. You can't really read it. It's just what's it doing? Where's it going? And then you see the big green, like there you go. We're just playing with us, man. They were just backing off. This is more, solid red, pull back, solid red. It's more like an opening drive, but in reverse. And I know I've flipped, and you can always flip these around the other way around, by the way. It's like an opening drive in reverse. It's like, heavy selling, pause, heavy selling. And you can get sucked into shorting that if you're kind of 50-50 at the open anyway, which is why you absolutely must have a stop, because this is a face ripper type move. But again, what we're kind of seeing here is real momentum that just kind of reverses. It just finds like it's momentum, but it's almost like it's, if you imagine who's doing these trades, it's almost like there's someone who's gone, right, I need to get out at the open. I don't care, dump my futures contract, dump my stock, whatever it is. And it's selling, and it's just overwhelming everything. The algos are backing off, market makers are backing off, spreads are widening, it's causing this liquidity. People just see this seller, they're joining the selling as well. You know, HFT guys are joining this. It's just causing that cascade of selling, and all of a sudden the seller goes, I'm done. Just goes shum, and it almost, everyone looks around and goes, okay, there's a big liquidity vacuum left. Off we go and we're buying, and then we just see the ramp back up. These are harder to trade. I think these are kind of the easiest ones to trade. Easiest, like I say, those are easy trades, guys. Easy, just wait for that and you make loads of money. Of course, there's more to it than that, but I find these slightly harder to read, and very often I think I'm a little bit late to these, and I think that's okay, like, because you know, you can trade this kind of trend line break thing, maybe trade an exhaustion, maybe trade like a high breakout, or maybe even trade this type of thing. And you rely on the fact there's a lot of people who could be trapped, who've been shorting into the hole, who now have to cover. So I feel like it's okay to be a little bit later on this, to wait for a little bit more confirmation, because if it's an opening drive, let's imagine it's that, but flipped, and you're there trying to fade it, you're going to be the one who's just getting caught out selling the low, or if we're around buying, you're just going to get caught. So I like to wait. If I see momentum, big momentum, you know, that takes time to turn. It might have one test up, retest lower, and maybe you can trade like a double bottom test, a little wick to the downside, have that, and then take a break at the high. So kind of, you know, you push down here, you take that maybe, if you don't even fancy that, maybe you take that and you structure it there. You know, it's playing that sort of game with these type of things, but being cautious as well that you could be in your mind, it's an open rejection, it's an open rejection reverse, open rejection reverse, and actually you're there fading a bloody opening drive, you just didn't realize what you were doing and you're getting caught out. Again, going back to the initial point at the beginning of the video, done a full circle now, keeping that risk managed, you know, having an allocated amount of capital you're prepared to risk at the open, and also, you know, I don't like allocating the whole day's max loss at the open. Like many people go, okay, my max loss for the day is X. Okay, off we go. and they look around sort of 20 minutes after the open and go, well, I'm stopped out for the day. And that's when it causes a little chimp to go, oh, why don't you carry on? You know, you're going to miss out. Blah, 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 blah. You have these little voices. Whereas if you allocate, let's say 50%, you say, okay, listen, if I take 50% hit on my max daily loss, I'm done for the open. I'll come back. I'll go walk away, come back and do look for another regime, another structure, another rhythm to kind of show itself and appear, and I'll trade from that. So it's just something I think is probably worth considering, not firing all your ammunition off for the open, because if you're out of tune with the open, you tend to be out of tune with the open, and you don't want to just give all your credits, all your kind of bullets away at the open and sit there and go, 20 minutes is done, it's going to be a busy day, I just got caught out because I misjudged it, the thing's ripping off, there's going to be a nice little rotation coming, I can get on, I can't because I've got no ammunition left and I must stick to my rules, and that's when you end up breaking your rules and you just open up a can of worms. So something to consider. Anyway guys, different open types, just 4 I've got for you today. There's other different nuances and different structures and stuff, but I think these are a good place to start, and hopefully that's been some value to you. That's been useful, it's been some value. If it is, appreciate a thumbs up. Take care, bye bye.